This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm John Tucker, filling in for Alex Steele.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at how a future Donald Trump presidency will impact electric vehicles.
Plus, we're going to discuss why shares of Tyson Foods surged the most in more than 2 years.
But first, we dive into corporate earnings from the media and entertainment giant Walt Disney.
Walt Disney reported fourth quarter sales and profit that beat Wall Street expectations and forecast earnings growth for the next 3 years.
For more, John and I were joined by Geetha Raghunathan, Bloomberg Intelligence analyst on U.S. media.
First, we asked Geetha for her take on Disney's most recent quarter.
What we saw was a lot of guidance, and we've never seen guidance laid out like this for us ever before. I mean, this was line by line item guidance for each of the different subdivisions at Disney, whether it was the theme park business or the streaming or movie studios. They kind of gave us, segment by segment numbers and exactly what to expect. And really, the biggest thing for Disney over the past few quarters has just been this lack of visibility and so much of investor uncertainty. And they just cleared it all up in this one, fell swoop with this earnings report.
They never did that for me, Geetha. I always had to guess on all that stuff. But for you, they just served it up on a silver platter. What got your attention the most from some of this guidance? What do you think the street really likes?
I think what the street really likes is you have high single-digit EPS growth. Remember, the street was projecting about 4 to 5%. So that's a nice uptick there for 2025. And then going into 2026 and 2027, they're looking at double-digit earnings growth. And the other bright spots were, the theme park business. Now, we do know that there is a moderation when it comes to the domestic theme park business, but it looks like things might not be actually as bad as we had feared. So domestic parks actually performed a little bit better than we expected. And then they talked about some weakness going into the fiscal first quarter. Remember, we did have those two big hurricanes in Florida. They do have a lot of cruise ships that they're launching, and so there's going to be some launch costs weighing on profit. But then you get into the second half of fiscal 2025, and they're expecting those cruise ships to contribute in a big way, and kind of the theme parks to also come back. So I think that's again some source of investor optimism and confidence.
Geetha, I get the streaming part. I'm not sure that I understand the linear TV part and why that's still part of the empire.
Yeah, nobody understands it, John. And that was actually a question for Hugh Johnston and Bob Iger at the earnings call. They're like, why should you be holding on to this business? Comcast just recently said that they're going to be kind of considering spinning off their cable TV network business. And remember, the big thing that's really coming up for Disney in 2025 is that they are launching this standalone ESPN product. And if they had any reservations in the past about jettisoning, the TV networks business because they were tied to the bundle through ESPN, this kind of definitely opens up the field for them, and it no longer ties them down to the bundle. So they were asked the question. They said that they're not looking into it. They like their portfolio just the way it is. But we really think that once they get that ESPN standalone streaming service up and running, they surely will kind of look into doing something more dramatic, I think, with the TV networks, especially given, a regulatory change.
Geetha, talk to us about the streaming business. They've finally turned profitable on that business. Give us the delta that you think that streaming business go to from losses to potential profits here.
Big turnaround, Paul. And I mean, this was really the big story for 2024, to go from $4 billion in losses in 2022, $2.5 billion in losses in 2023, to finally squeaking out a profit here in 2024. And remember, they've just barely broken even, so about $150 million in profit. But the whole story is how they kind of build on that $150 million. So Netflix this year is going to report about $10 billion in profit. And I think there's some encouraging commentary. So they already kind of guided, they gave us actually hard numbers for the streaming profit for both fiscal 2025 and 2026. So 2025, they said over $1 billion in profit. And in 2026, they actually gave us a margin number, double-digit margins. And remember, this is the big story. Everybody is chasing those 25% operating margins that Netflix has already achieved. And so Disney it looks like, I mean, they obviously have a lot of catching up to do, but they're closing in.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media.
This week, we focused on a Bloomberg Big Take story entitled Trump's Win Puts Musk in the White House's New C-Suite.
You can find it on Bloomberg.com and on the terminal. The story looks at how Tesla CEO Elon Musk spent at least $132 million to help Donald Trump's re-election as U.S. president. And now Musk will have a role in Trump's new administration.
For more, guest host Jess Metton and I were joined by one of the story's authors, Max Chafkin, Bloomberg Businessweek senior reporter. We first asked Max what we know about Elon Musk's new role.
We learned a little bit more just after this story was published. Donald Trump made something official that he had teased and that Elon Musk had teased repeatedly on the campaign trail. Elon Musk will be the person charged with providing advice on the streamlining of government. Now, that could mean any number of things. It could mean, I think, very little. It could also mean that as Donald Trump prepares to enact his, very ambitious agenda, that Elon Musk will be at his side. And that'll be my bet. I mean, I think the job thing is probably a distraction. The most important question in the Trump White House is who has Trump's ear. And right now, that's Elon Musk. And I think as we put together this story and as I've been thinking about this, Elon Musk throws him into these companies. And famously, he has 6 different companies, Tesla and SpaceX, his car company and rocket company being the big ones. I think we need to start thinking about politics, and in particular, Elon Musk's role in right-wing politics, whether it's the next Trump administration, or even beyond that, as his other big company, as something that he is going to be devoting a lot of time to and trying to use it, frankly, to benefit his other interests.
Leading a commission specifically outside of government, Elon Musk doesn't have to divest his personal financial holdings when making recommendations to the White House on federal spending and regulations that he wants to cut. I mean, what sort of precedents do we have for something that's created that's supposed to be specifically outside government? And what power can he yield and not yield? Do we have any indications on that?
There have been lots of presidential commissions. This kind of thing is not necessarily anything new. It's really just a question of how closely is Donald Trump listening to it. And when Elon Musk, he suggested all kinds of very radical things that are likely to be either difficult to achieve, like practically working within the confines of government, or wildly unpopular, or both. So, he suggested, for instance, that he's going to Twitter the U.S. government, suggesting, massive layoffs. Remember, he laid off 80% of the Twitter staff. He is not going to lay off 80% of the U.S. government. I think that would be a very, very, very surprising thing if it were to happen. That said, Trump is going to try to defund aspects of the government, and it really seems like Elon Musk is going to play a role in deciding what gets defunded, which is, of course, is going to raise all sorts of ethical concerns and questions. And because there are ways that President-elect Trump is going to be in a position to, say, squash investigations into Elon Musk companies, or direct funds to Elon Musk companies, or slow down some of Elon Musk's competitors. And so, it's going to keep journalists busy. I'm sure that the left is going to be very focused on this over the next couple of years, because Elon Musk, who's a polarizing guy, is going to be tied to this administration very closely.
I mean, Elon Musk, you cited in your article, and you just mentioned here, all the companies he runs, Tesla, SpaceX, Neuralink, on and on and on. How many hours in a day does this guy have? I mean,
you haven't even mentioned his video games.
When you think about how many companies he owns, too.
Yes, plays a lot of video games. which is one of the many head scratchers with this extraordinary man. I think we've seen investors in some of these other companies get concerned, and right now we're in the middle of this kind of honeymoon phase. There's a mania to the way Elon Musk is talking about this stuff. He's in Mar-a-Lago, he's in Washington. Trump family members are referring to him as Uncle Elon. You got to think that this is not going to last, and if it were to last, that there would be a bit of a come down because as you say, Tesla is a big, complicated company with lots of challenges. And right now we're seeing a lot of investors bid up the stock, but there isn't a ton of, it's not like there's a clear rationale for why Tesla is suddenly worth like 40% more than it was before the election, except that, hey, maybe Trump's going to make things better. But there are going to be challenges, and distraction is going to be something that we're going to be looking at.
And what about EV policies? Because it seemed like they were more beneficial toward Tesla maybe under the Biden administration rather than the prior Trump administration. So how does this sort of shift, and when you have kind of the Trump 2.0 coming in?
I mean, this is one of the things that's so strange because Elon Musk became much more conservative during the Biden years, but the Biden years were incredibly good to Tesla. Tesla's value, shot way up. It went from being kind of a niche player to one of the large American car companies. And, Trump, as you kind of hint, was very critical about electric vehicles on the campaign trail. Now, there are two things here that are probably worth bringing up. One is where Tesla is now is very different than it was 4 or 5 years ago. And you could make an argument that these electric vehicle subsidies actually do more for Tesla's competitors than they do for Tesla itself. So, like, if you were to remove all these subsidies, yes, it might cost Tesla investors money, but it would also sort of help Tesla lock in its very, very dominant position in the market. And the second thing, probably the more important thing, is that Elon Musk is desperately trying to move beyond the auto business. He wants Tesla to be an AI company. He wants to have robo-taxis. There is no regulatory regime there. And I think what investors are hoping, and again, I don't know that they have much sort of clear factual basis for this hope, but this is the rationale that Trump will basically legalize this business, that he will take a very dicey regulatory situation and make it less dicey, and that will be worth a lot of money to Tesla and ultimately to its shareholders.
30 seconds left. Max, how much time do we think Elon Musk is going to allocate to the government stuff?
Well, right now it seems like it's a full-time job, right? I mean, he seems to be there quite a lot. I think this is going to be something that he's very, very focused on, probably as long as it lasts, which maybe that's only going to be a couple of months. Maybe it's going to be longer. He has signaled that he wants to play in politics beyond this, beyond 2024. He's talking about the midterms already. So we'll see.
All right, thanks to Max Chafkin, Bloomberg Businessweek senior reporter. Coming up, we'll break down how oil producers will be impacted by a Donald Trump presidency.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm John Tucker. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm John Tucker, filling in for Alex Steele. Last week, Donald Trump was elected the 47th President of the United States, reclaiming the White House and pulling off a stunning political comeback. And now many industries are wondering how they'll be impacted in 2025. For more, guest host Matt Miller and I were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Manager. We first asked Steve for his take on how the EV industry will be affected by Donald Trump.
Yeah, if Trump decides to kind of remove or cut the $7,500 tax credit or EV tax credit, I think most people believe that the EV penetration will stall. If not stall, it will probably fall, because a lot of the consumers are relying on that $7,500 to make sure, to bring down the price, the effective price of the vehicle. Most EVs sold in America are still very expensive. There's only a limited number of them that are under $50,000. So the fear is, it's going to stall EV penetration. the automaker is going to have a hard time because they've already invested. They've already committed to investing a lot of money under the Inflation Reduction Act, about over $150 billion to onshore a lot of the supply chain. So it's going to cause a lot of chaos within the industry.
So they'll be under no pressure whatsoever moving forward, possibly to increase sales of EVs.
Yeah, I think the automakers are going to have to increase incentives. I think what could happen if the EV penetration rate does decrease from about 8% currently in the US, is going to be left with the strongest players. And that, to me, that looks like it's Tesla, because Tesla does have the lowest cost structure amongst all the EV makers in the US. And if the market shrinks, the weaker ones will probably fall on the wayside.
And oddly enough, first bro, or what do we call him, first friend, Elon Musk, he's not necessarily in favor of these tax subsidies for EVs.
Yeah, I think, to him, he thinks Tesla doesn't need them, and it's partly true. If you look at the amount of cars that are leased and eligible for the 7,500, actually a lot of the 7,500 tax credit is actually from leased vehicles. If you look at the amount of leased vehicles that Tesla have sold in the past 12 months, it's about 20%. So they'll get impacted. But if you compare it to Rivian, Rivian has about 50% of their vehicles leased, and those and eligible for the 7,500. So it could be a bigger impact in Rivian.
Yeah, there's a limit on you don't get the tax credit if you're buying a vehicle that costs more than $80,000, and I believe there's a household income requirement as well. You have to be below a certain level. But if you lease it, you can get around at least one part of that tax credit. Isn't that right, Steve?
That's right. That's actually what I'm referring to. So when we look at the companies who's going to get impacted, we really look at, how many of those vehicles are leased. If you look at EVs in general in the U.S., the leasing penetration is actually upwards of 75, 80, 90%. So a lot of people that actually buy EVs are leasing it to get that $7,500.
What does the EV market look like right now? I mean, I know if you read the headlines, you would think that no one has bought an EV this year. Like, the industry's in trouble because they're so unpopular, not just politically, but, since they're difficult to charge for a lot of people, it's just not an option. However, don't we still see EV sales actually growing?
Oh, we are. We are seeing EV sales growing, especially in the second half of this year, because there's been a lot of price cuts, right, over the past 18, 24 months in the industry. And a lot of these vehicles have become more affordable. And even, especially in the used EV market, those vehicles are very competitive to gasoline cars. What the industry is really facing is getting more impacted by the fact that interest rates are high. A lot of people cannot afford expensive cars these days, and EVs are a little bit more expensive than ICE at the moment. So what the industry was trying to do, and I think what the IRA was trying to do, was trying to onshore a lot of the production, onshore a lot of the supply chain in the US in hopes of bringing costs down, so automakers can offer more affordable EVs. And that's what we were expecting. We were actually expecting the EV penetration rate to rise, especially into 2026 and 2027.
Well,
when
Steve,
more
I got to break in here because I feel like Americans have shown a propensity for taking on $1,000 plus monthly payments. I don't think it's about the price, frankly.
Where do you charge it? That's my concern.
That's the big problem. I'm test driving right now a GMC Sierra EV. It is a fantastic vehicle. It's expensive. Yes. But I think a lot of people are willing to take on debt to own a car like that. The problem is there's nowhere to charge it. I park in a garage across the street in Manhattan, capital of the world, and the only option they offer is the slowest potential charge for $20 a day. So it's just not worth it.
Yeah, I think that's a very good point. Affordability is not the only hurdle. It's the charging and the range. And, depending on the use, I think a lot of people with a second vehicle may get an EV. Someone who's using it for daily commutes may get an EV, but America is a big country, and people love to drive cars, and there are a big majority of car buyers that are, probably staying away from EVs because of that.
All right, thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Manager.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agriculture sectors. This week, we took a look at how Donald Trump's upcoming presidency will impact the oil industry.
For more, guest host Molly Smith and I were joined by Tai Liu, BNEF Oil Market Specialist. We first asked Tai if it is a fair assumption that Donald Trump will be good for the energy industry.
I think the U.S. oil industry and the gas industry can benefit from the Trump administration in a number of ways. I think the first off the bat is like a lower corporate tax rate. So President-elect Trump has indicated he would like to lower corporate tax rates from the current 21% to 15%. So if that materializes, that's right off the bat, that's like more money for the industry and for the shareholders.
What are they going to do with that money then? Are you suggesting it would be share buybacks?
Yeah, so there's definitely like a number of options these companies can do with this quote unquote extra money. They can, like you said, they can do more buyback for the shares. They can issue more dividend payouts. They can reduce the debt. And finally, they always have the option to funnel some of this money into capital expenditures, which ultimately will translate into more production down the road.
From the regulatory standpoint, I mean, can I go down there now and drill a well? Can I make a pipeline to take my natural gas to Corpus Christi or wherever it needs to get to? Is it going to be easier under a second Trump administration to build energy stuff?
Yeah, I would definitely think so. So under the Biden administration, the government has imposed a lot of regulations that are deemed as unfriendly to the oil and gas industry. The government issued a drilling rights moratorium. They placed a pause on energy exports permits, and they also increased royalties on federal land leases. And I would presume, and all of these were pretty hostile and created a lot of uncertainty to the industry. So I would think that Trump administration would remove a lot of these regulations that are deemed as onerous to oil and gas producers. So definitely beneficial from that point of view.
You mentioned before, increasing CapEx potentially and how that would mean more production. You got to though worry about prices. If you are producing so much more, what happens to the supply-demand equation there? Is that already something that drillers are thinking about, of how much more they might want to maybe not go in too much?
Yeah, that's for sure. So if you look at the past 10 years, U.S. oil producers have, on several occasions, crashed the oil prices when they decided to turn on the production taps. So they're very cognizant of the risk this time around. On top of that, there's like a lot of shareholder pressures on these oil and gas companies to maintain capital discipline and to increase capital payback. So from that sense, I think even though if there's like more money to go around in the industry, it would be much harder for the U.S. oil producers to grow production the way they did in the past 10 years or so.
When did the U.S. become a net exporter, like 2016 or something like that?
Yeah, I think so.
So we were a net importer forever. Then we became, thanks to the shale finds, we became a net exporter. How does the U.S. oil industry, I'm not sure if you can even characterize it, or is it just individual companies, how does the U.S. oil industry interact with OPEC, if at all?
So the way I think about it, they're very competitive, like natural competitors against each other. So if lower taxes in the Trump administration materializes, it would definitely make the U.S. oil patch a lot more competitive. It will also lower the break-even calculations. There will be more money to go around. So it will make it much harder for OPEC to increase their output. So it's going to place OPEC on a more difficult ground.
Something that in part got Donald Trump reelected to the White House was the idea of bringing prices down. And, gas prices, obviously a big sticking point for a lot of Americans. Gas prices have been coming down pretty consistently over the past, 6 months or so, down to now like about roughly $3 a gallon on average nationwide. What can Trump really do for gas prices?
Well, when I think about gas prices, there are two pieces to it. There's the crude oil price part, and then there's the refinery margin part. Now, on the refinery margin, there's probably not much a president can do to it because you basically have to increase refining capacity, and that takes years to build out if you want to play with that part. The other part would be the oil price part. Now, if you reduce regulations, make it easier for companies to drill, you can theoretically, you can prevent some of the possible price spikes in oil prices just because it's less onerous for these drillers to put more capital into the ground. So in that sense, you can help prices from seeing more spikes. But however, I don't think these companies will really go all out and drill again the way they did before for the reasons we talked about before.
So what's happened to the Russian oil? It's been a couple of years now. Mm-hmm. And if it's not going to Germany, where's it going?
Yeah, so it's not going to the Western European nations, and Western nations has placed sanctions on Russian oil. So a lot of that has been brought up by countries like India and China. So they're really benefiting from these sanctions.
So these sanctions aren't really working, are they?
They're redirecting trade flow.
They're redirecting trade flow.
And they're making it harder for Russia to ship their oils around the world, so it does increase the cost on the Russian oil producers. So that's an impact, but the impact I feel like is probably more limited.
All right, thanks to Tai Lu, BNEF oil market specialist. And just ahead on the program, we're going to look at how Wall Street math wizards are decoding private market returns.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm John Tucker, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Paul Sweeney.
And I'm John Tucker, filling in for Alex Steele.
We move next to corporate earnings from Tyson Foods. This week, shares of Tyson Foods surged the most in more than 2 years.
That's after the company beat fourth quarter earnings expectations and projected stronger results next year. And this comes as a turnaround at Tyson's chicken business offset losses in beef.
For more, guest host Jess Menton and I were joined by Jen Bartashis, Bloomberg Intelligence senior retail analyst. We first asked Jen for her take on Tyson Foods' most recent quarter.
And I think what we really saw was they were able to end their fiscal year on a high note. That's really been a culmination of a lot of effort to streamline and improve their business. They've been very inconsistent in the last few years, so it is a little refreshing to see that they finally seem to have gotten their arms around some of the problems that they were having and seem to be on a very good trajectory going forward.
Talk to us more maybe about the inflation picture, because it looks like Tyson's second largest source of revenue, actually demand for chicken actually improved because consumers were looking for those cheaper alternatives to beef. So what do you think this tells us about inflation right now?
It's a great question. And with regards to inflation, there's a dual effect that Tyson has. The first is because they are so big in chicken, it's obviously a benefit to them. When people are trading down or they're seeking cheap protein to put on their table, chicken is a big answer to that question. And Tyson is definitely reaping the benefits of that. A little bit harder and a little bit more nuanced is the impact that inflation has on their prepared food segment. That's on the things that you find in the frozen aisle, in the refrigerated aisle. Those are higher cost items usually, and they're a little bit higher margin for Tyson. So finding the right balance has been important as consumers look for those prices to come down a little bit further as well.
So what drives their business? Top line revenue drivers, is it kind of a GDP story? Is it something different than that?
It really is a reflection of where the consumer is. It is really about where the demand is going to fall. When it comes to cost drivers for Tyson, they really benefit from lower grain prices. So when corn comes down, soy comes down, that's good because that's the feedstock for the animals. But the way that Tyson goes usually follows just the general consumer and where they're trending and how incomes are progressing.
Something earlier this year I thought was interesting because I talked to you about kind of price mix when it came to another segment in the consumer staples category when it came to consumer packaged good type companies. Obviously, if you look at Tyson's Food too, when it comes to those types of food, beverage, food product type companies that are distributing packaged foods and meats, how do you view kind of when you were talking to me earlier this year about promotional sales for a lot of these types of companies in the back half of the year, like buy one, get one free, different things like like that as far as what this shows us about maybe consumer spending and what a lot of these companies, when they are distributing these types of goods, how they're faring?
It's a big topic for these companies. And so when you're looking at volumes, almost every packaged food company started this year saying they were going to grow volumes. And yet very few have actually been able to actually realize volume growth this year. And that's really because the shoppers have been so conservative on their spending and they've been seeking deals. There's been a lot of pressure to run promotions. And so we've seen promotional activity tick up substantially in the last quarter and in the second half of this year overall. And we're seeing more deals, more discounts, and all of that is usually coming at the price of the packaged food company, not necessarily the retailer. So that's good news for consumers who are looking for deals. It makes it a much harder process to manage for the packaged food companies. So for Tyson, part of what they've really been working on is increasing their innovation pipeline, things where they can bring new products to market and have a different price point for those. And that's a similar strategy to what a lot of these other packaged food companies are trying to do to just generate consumer interest in their products again.
So, Jen, I know Tyson, they actually have adjusted operating income losses for beef and pork. Why is that?
Yes. Well, when you look at the beef market, we have a shortage of beef. The animals are getting bigger, so there's still beef there. But because of that, prices have been a lot higher. And it's been a little bit more expensive for consumers in terms of purchasing beef, and certainly specific cuts of beef. And what we're seeing in the cattle market are very few signs that that's going to change anytime soon. So at this moment, we're thinking we're not going to see big signs that the cattle market is going to expand again until the end of calendar 2025. So that's still a good ways away, which is part of why the company guided to a loss in adjusted operating income for the beef segment for 2025.
Our thanks to Jen Bartashis, Bloomberg Intelligence senior analyst, retail staples and packaged food.
This week, we took a look at a Bloomberg big take story entitled Wall Street Math Wizards Are Decoding Private Market Returns.
You can find it on Bloomberg.com and the terminal. The story looks at how a small band of math wizards want to demystify private market returns.
For more, guest host Molly Smith and I were joined by the story's author, Justina Lee, Bloomberg Markets reporter. We first asked Justina for more context on her latest story.
If we kind of think about, what's been happening to active management in the stock market for the past few decades, I mean, these days we're really used to talking about alpha and beta and kind of how does your performance compare to the benchmark? And that's really killed a lot of the business. And I think what my story tries to bring up is, could we see a similar revolution in private markets? And of course, it's a way harder math to crunch because as you mentioned, you don't have the numbers as often, and a lot of the time, the numbers are quite subjective. But we are seeing a lot of interesting quant research here, and they are trying to kind of use some statistical techniques to kind of reveal the risks and also to compare performance within private markets.
And so much of what comparing performance needs is obviously a benchmark, and talking about how the S&P 500 is the natural benchmark for so many companies. Does that still apply in private markets? Does that still make sense to be comparing these returns against a basket of publicly traded companies?
Yeah, that really is a big question here, because even if you use a lot of these quant techniques, you still need to choose a benchmark to compare private markets to. And actually, it can tell you a very different kind of story depending on which benchmark you pick. Like in my story, I cited this paper from public market quants saying that, if you compare PE to S&P 500, I mean, the average PE fund actually does quite well. But if you compare it to like small cap value, come up, maybe perhaps you might think that looks more like a PE portfolio. It actually loses to small cap value. And I think that really is the big question here, because if you're an investor and you can get better returns in public markets, I mean, you're paying way less fees in public markets. And so you wouldn't want to be in PE.
What is the direct alpha approach?
Yeah, so this direct alpha approach was kind of invented by this guy, Barry Griffiths, who was at Landmark Partners for a long time. And then when that was acquired by Ares, he was the head quant in Ares. And the math is actually not that complicated. It's mostly to compare kind of the cash flows you get from PE kind of with the opportunity cost of what you would have gotten if you had invested that in public markets. And so the idea there is kind of a more apples to apples comparison to what you could have gotten. And then that's supposed to kind of raise the question of, were the fees worth it, or was locking up your money worth it? Because even if you are getting better returns in private equity, a lot of the time it might not be worth it if you think it's riskier because you cannot sell out of it, or you think it's riskier because it's using more leverage. And so I think a lot of the quant research is kind of bringing forth these questions.
Give us a sense, Justina, of what some of these fees are like, because on the public side, it's really been the story is the race to the bottom in fees, especially with the proliferation of ETFs and other funds that you can get into with passive management. So how expensive is it if you're an investor in some of these private funds?
Yeah, so a lot of these private funds do have a hurdle rate. And interestingly, the hurdle rate is pretty standard, like around 8%. And then you kind of start earning kind of carry above and beyond that. And that carry has actually increased this year because we are seeing a bit more deal making pick up as well.
All right, here's my big issue with private investments is just the mark to market. I think it's just so unevenly applied. I don't feel like there's any consistency. Again, as I was mentioning to Molly, private equity folks are happy to mark on the way up, but I don't recall anybody reporting terrible marks in 2022 when stocks and bonds were both down double digits. Talk to us about that part of the business.
Yeah, and I think that is the big question right now, because the defining theme of the last 2 years is that we're not really seeing a lot of exits from PE investments. And because of that, a lot of investors, your pensions and your endowments are not getting their cash back. And the reason for that seems to be that a lot of PE firms don't want to sell into this market. So maybe they're not getting valuations that they like, even though the market has been kind of going up. And I think that kind of reflects sort of the disconnect here. Like maybe private markets haven't really caught up with sort of the 2022 adjustment from higher interest rates here. And so if you actually kind of look at some of these math techniques that's being used to unsmooth the volatility, what you get is actually a volatility level that's very similar to the S&P 500. So, but a lot of people would say maybe investors do like the smooth volatility, even if it's not the truth. So that is one cynical take that we hear a lot.
Mm-hmm. What do you hear from other people outside of private markets about some of these math techniques? Do they pass the so-called sniff test? They seem legit, or because I guess for maybe where my head is going is, the way that companies can sometimes make really creative adjustments to what their earnings looks like. And it's is that maybe just a little bit too rosy? So tell us a little bit about what the feedback has been on what these quants are doing.
Yeah, I think, using these quant techniques is definitely not the standard here. And I think if you talk to a lot of allocators, they will tell you sort of the practical side of things, which is that, since 2008, PE generally has, at least on the surface, done better than, public markets. And most people are pretty happy with that. And they kind of feel like, even if it is actually riskier, who cares, right? I have a kind of a quote from a guy who's very familiar with PE where he's like, well, there's more cash coming out of this box. So do we really need to dig that deeper? Do we really need to torture the data? But I think there's also more interest in these methods right now because there's a sense out here that with interest rates higher and kind of with maybe just riding valuations getting a bit more difficult, we're entering into a tougher period for private equity. And so people will actually start to ask these questions.
Our thanks to Justina Lee, Bloomberg Markets reporter.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.